Hello, I'm Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. Great show for you this Sunday morning. A lot of information to cover. If you have questions about your portfolio, your relationship you're currently having with your advisor, if it's not working, any financial questions, send those to Brian Rezny at ReznyWealth.com, and make sure you visit our website, ReznyWealth.com. You know, one of the areas that I want to discuss just a little bit is, of course, generally speaking about the U.S. economy. I've had a lot of questions about trade policy, and is that really going to have a negative impact on the U.S. economy? What about the current tax new rules and so forth for corporations and individuals? At the end of the day, if you look at tax reform, that's going to be a net positive. If you look at some of the trade discussions and things that are being floated about today, to me, those are going to be short-term in nature. I firmly believe our trade's going to be net positive. I think some of the penalties we're going to put on some of these countries that are cheating or abusing will have very little impact against us. I think it'll help us positive, but I don't think it'll have a real negative. So I'm not really overly concerned. I'm more excited about the tax cuts on the corporate side and the individual side, because ultimately more money in corporations' pockets, they can expand, hire more people, more money in your pocket, of course, more money for you to spend, good for the economy, not only in the U.S., but the world. Today's topic, I want to talk about your biggest investment risk. It's not what you think it is, though, and this is the big problem. I get a lot of questions about trade or taxes or recession, but your biggest risk is not what you really think it is. Salesman or real money manager? Which one do you entrust your life savings with? If I interview 100 different people at one of my offices, maybe 2 or 3 out of 100 are working with a fee-only fiduciary firm. The rest are working with Wall Street firms, banks, or insurance companies, either in a fee-based arrangement or under suitability. Or they're working with one of these annuity charlatans that all they do is they push annuities on you unsuspecting investors. Your biggest risk is who you entrust with your money. You get a salesman, kiss your wealth goodbye, kiss your financial security goodbye, and that is a major problem. Suitability standard versus fiduciary. I've talked about it before, but I want to talk about it again. If your house is on fire, who do you call? You call the fire department. You call 911. A fire truck shows up to your house. It looks like a fire truck. Firemen jump off the fire truck with their hoses. They look like firemen. Guess what, folks? There are not fake firemen. They're real. The problem in the investment business is, in our estimation, 90% of these firms and or their advisors are really in the salesman business, not the money management business. And again, in our estimation, 90% of these firms work either under suitability or some form of suitability with substantial conflicts of interest against your money. And I know what you're saying. That's not my guy, but it has to be. Because again, we estimate 10% of firms nationally are fee-only fiduciary money management firms. That means 90% are the banks, the insurance companies, the Wall Street companies. Chances are 9 out of 10 of our listeners are working with one of these firms now, and I will almost guarantee the majority of you are probably questioning the advice you are currently receiving. Fee-only fiduciary advisor, fee-based advisor, or commission-based salesman. Those are the 3 types of advisory firms out there today. Fee-only fiduciary always works in your best interest. Let me explain. Again, your house is on fire, you call the fire department. The red truck shows up, the firemen jump out. They start to squirt water on your house. That's a fee-only fiduciary. They're always firemen, they're always trying to put out the fire. Fee-based advisors sometimes work in your best interest, but sometimes they're arsonists. Is sometimes good enough for you? Let me explain. Your house is on fire. You call the fire department. A truck shows up. Half the truck looks like a fire truck with firemen. The other half of the truck doesn't quite look like a fire truck. you say to yourself. The first crew on the fire truck puts water on your house. The second crew on the truck starts to squirt gasoline on your house, an arsonist. Under a fiduciary rule, they'd have to act like a fireman. Under the suitability rule, they don't legally work for you or have to give you the best advice. They just have to sell you what you're suitable. So bottom line is, half of your money maybe is being managed properly. The other half of the money, they're selling you non-traded REITs, variable annuities, commission products, structured products through their firm, all the things that are going to wreak havoc on your money. So ask yourself this, is sometimes good enough for your wealth? Is sometimes good enough when your house is burning down? Is it sometimes good enough to use gas or sometimes good enough to use water? You have to make that decision. If you're working with any bank, any insurance company, any Wall Street type firm, none of these firms are fee-only fiduciary firms 100% of the time. Then you have the commission-based salaried advisor salesman. Is not a real advisor at all. They're an arsonist, in our opinion, all the time. What that means is this. You go into their office, it's a bait and switch. Everything is there to sell you some kind of commission product, whether it's a non-traded REIT, whether it's a variable annuity, whether it's one of these index equity crummy annuities. The bottom line is you've got an arsonist. So now when you call 911, a truck shows up. It clearly kind of looks like a truck, but is definitely not a fire truck, but you're not sure. They jump off with a hose, and all they do is squirt gasoline on your house, and they put the blaze up even more. Do you want an arsonist under suitability working on your portfolio and selling you inferior investments and legally do not have to give you the best information? I estimate, again, 10% of firms nationally are fee-only fiduciary firms. 90% of the other so-called advisors or advisory firms are either fee-based or full suitability commission. Which one do you entrust your life savings? Which one do you want to have working on your hard-earned money the next 5, 10, 15, 20 years? Can you trust your current advisor? Is your current advisor an arsonist? Do you know? Do you really know if they're working for you or against you? Go to my website, reznywealth.com, download for free, Fiduciary versus Suitability. It's right on the homepage. It's a free report. It describes this in more detail. I will tell you statistically, less than 1% of you have ever used that fiduciary questionnaire with your current advisor to get the truth and the facts about the relationship you have, and it's costing you if you don't. Don't let your current advisor burn down your retirement. Only you are to blame if you don't check out the firm and understand the difference. Check them out, finra.org, sec.gov. These brokerage firms, banks, and insurance company constantly are fined and censured by both of these two entities. Have you ever gone there and checked out the firm you entrust your money? What we find is less than 1% of people we interview have even heard of FINRA or the SEC site to check out your current advisor. Both are listed on that free report on my website. Fee-only advisor is the only real advisor that legally works for you 100% of the time and is a fireman, not an arsonist. Know the difference. Get a second opinion. Call my firm today. Visit our website, reznywealth.com. At our website, you'll see a whole bunch of great information and free reports. One of our #1 downloaded reports is 3 investment risks you must avoid now, and suitability versus fiduciary. Real advisor or an arsonist? What is in your pocket? Who's managing your money, or are they burning down your portfolio and your retirement? I'm going to take a quick break. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Is your so-called advisor really just an annuity salesman? Fact. Annuities are sold by misleading you, the investor. Sky-high expenses, crazy surrender penalties, and mediocre investments rob your returns and rob your security. My advice, stop being sold. If you want real money management, real advice, call my firm today. taking your questions. Make sure you send those to Brian Rezny at ReznyWealth.com. And of course, visit our website. I know we're getting a lot of email questions. We always do. When you do go to our website, by the way, I do a live radio show for 2 hours Sunday mornings, 10 to noon. Great show, another great way to do live call-in questions. But as always, get a second opinion. If you are questioning the advice you're getting, don't settle. Don't let somebody sell you the proverbial bag of junk in your portfolio. I see people just being taken advantage of all the time under suitability and these fee-based firms. It's sad. You can do something about it. You have to do something about it. Stop settling and make sure you visit our website, schedule a second opinion consultation. You'll be glad you did. Sam from Chicago, Illinois. I'm worried about North Korea and the market sell-off. Should I be? Sam, I would not be overly worried about North Korea. Remember, we've had geopolitical events in this country ever since we've been, really, America. And those aren't going to go away anytime soon. There's always going to be something that's going to upset the apple cart temporarily. I don't see North Korea to be a huge problem long term. Hopefully it will be dealt with, but I don't see it cascading and collapsing the U.S. economy. Remember, there's a lot of negative news out there all the time. It's your ability to decipher that news and put it in the waste can. You know, media is filled 24/7 today, and everything's hyped up often. People get overly emotional because of what they hear on TV sometimes, and they basically then make bad investment choices or decisions. Make the right decisions for your money. What's your strategy? Follow that strategy. If you're unable to do that, find a real money management firm like Rezny Wealth Management. Let us manage your money properly so that you can relax, have your retirement, go boating, golfing, whatever you want to do. But if you don't have the ability to do it yourself, or your current firm is not doing it right, then it's time you call my firm. Jonathan from Naples, Florida. Do you agree? Do you think asset allocation is a good strategy? Jonathan, I do not think asset allocation is a good strategy. Let me explain. Banks, Wall Street firms, and insurance companies do asset allocation. All that is we call it the failed pie. They basically take your money, spread it in a bunch of different asset categories, and collect a fee. That's it. They don't really have a risk management strategy, meaning if we go into the next recession, are you going to hedge my portfolio? Are you going to reduce risk in my portfolio? They're going to say no. You're always going to own bonds in your portfolio, even though bonds are not appropriate in an asset allocation strategy. You're always going to own a REIT. You might own some corporate bonds, gold, whatever. They put a lot of junk in the asset allocation. Some things work, some things don't. What we find is you then call my firm after 4 or 5 years in an asset allocation approach. You realize you haven't done that well. And then the question always comes up, if you didn't do so well when times were good with your asset allocation, what's going to happen when times are bad? You're still going to lose. Bottom line, asset allocation is a way for Wall Street to sell you an overpriced, ineffective strategy. Active management that's appropriate, being in the right asset categories that are appropriate, in our opinion, is a more sound strategy. And always have a risk management strategy, which I can tell you the vast majority of these banks, insurance companies, and Wall Street firms do not have any strategy for risk management at all. Bud from Marco Island, Florida. Would you invest three variable annuities? One is pass surrender, and our other current advisor suggesting a non-traded REIT. What are your thoughts? I think what you're saying is you invested in 3 variable annuities, and one is pass surrender, and your current advisor wants you now to take that out and put that in a non-traded REIT. If that's the question, I would say absolutely not. First off, your advisor is not an advisor at all. Your advisor is what we consider suitability or an arsonist. They're not working in your legal best interest. Variable annuities are commission products. Non-traded REITs are commission products. Your so-called advisor is really a broker, and he's looking to line his pocket with the highest commission. Both of those 2 products are amongst the highest commission. What you're doing is you're taking your money out of a variable annuity, and you're going to go put it into a non-traded REIT that's going to insanely lock your money up again and probably take about an 18 to 20% haircut off the top of your money. You need to get yourself a second opinion. Don't go the route that your so-called advisor, salesperson is now pushing. The advice you got before was bad. The annuities themselves have incredibly high annual cost structure, which has already robbed your returns for the time frame you've owned those. And it'll continue to rob them. You put it into a non-traded REIT, another huge mistake. Get a second opinion. Find yourself a real firm, fee-only, fiduciary money manager. Variable annuities or any annuity, non-traded REITs do not belong in your portfolio. That is the main point of your answer for your question. Ron from Naples, Florida. What can investors do in the event of a market downturn? Can we expect another interest rate hike? Ron, first off, yes, we're going to get more interest rate hikes because the economy is doing a little better. What should you do if we have a market downturn? We have two kind of markets. We have a market that has normal volatility, where you get a 10% correction every single year. That's pretty normal. And then it usually rebounds and we have a chance to go to new high ground. The other kind of downturn is a recession. Those happen every 7 to 8 years, 3 to 4 years, 20 years apart. It depends how the economy is rolling and if it gets overheated. There's a lot of variables. For normal volatility, you're not going to do anything. You're not going to just go and sell. You might reposition some of your money into better opportunities, something that didn't sell off as much maybe, depending on your strategy. But the big one, to answer your question, is recession. What's your strategy for risk management in a recession? Every recession that's come about in the U.S. has come from an overheated economy that wasn't sustainable. It's like speeding down the road at 85 in a 70. You're not going to do that for long before you see Mr. Policeman with the flashing lights, and you're going to slow down. So what I would say is this. Do you have a strategy to manage the risk in your portfolio if the next recession comes in an overheated economy? You need to be doing research. You need to have buy and sell criteria for that strategy. I can tell you we look at a lot of research, and part of how we manage money is managing the risk for recessions. If our research that we utilize starts signaling those recessionary type indicators, we will start to get more defensive within our managed accounts. I hope you do the same. Sue from Naples, Florida. What sectors perform exceptionally well in a growing economy? That is an excellent question. Okay. Sectors will change from time to time, but general sectors. I don't know that I would look at just sectors, but I would look at areas of not only our economy, but the world economy. A couple areas that we like right now. Small cap stocks in the U.S. and emerging market stocks, of course, outside the U.S. I think both of those have great opportunity on the long term. You're going to get some volatility, but I will tell you, when we look at portfolios that come into our office, newer clients, few of them ever have any small cap or emerging market exposure or very little. The areas that are the greatest opportunity in a growing economy are often small cap and emerging market equities. Most people, again, have either none or very little exposure. That's because most firms practice what's called stock asset allocation. Instead of going in areas that have opportunity, the money's spread everywhere, and to me, that's a failed strategy. Don from Lauderdale, Florida. Brian, what is your opinion of whole life insurance? Our agent is recommending a $500,000 policy for me at 45. Don, don't do it. The only kind of insurance you should buy is cheap term insurance. If you're 45, I would take a look at doing, like, let's say, a 20 or 30-year level term policy. It'll be a lot cheaper than the whole life policy. You can then take the money that you save and invest it for your retirement. Whole life insurance is a ripoff, and your insurance agent loves it because they pay huge commissions to him or her. Don't do it. The only kind of insurance that you want to own is cheap insurance, because all insurance pays when you die. So buy cheap term, invest the difference, make your family wealthy instead of Mr. Insurance Salesman, and do not buy a whole life insurance policy. That would be devastating. Go to ReznyWealth.com, folks. I'm going to take a short break. We've got more questions coming up, and as I always suggest, we have offices right here in Naples and in Fort Myers. Schedule a consultation. If you're unhappy, do not settle for mediocre advice. Get a second opinion. Don't procrastinate. Don't hurt your financial security. Talk to Rezny Wealth Management today. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Is your broker working in your best interests, or are you being sold inferior investments by Wall Street firms and annuity salespeople? My advice, never settle for bad advice if you value your financial and retirement security. Real money management, real advice is the difference my firm provides. Call us today and schedule a consultation. Hello, we've got questions, more questions coming in. Of course, send them to Brian Rezny at ReznyWealth.com. And again, make sure you call my office, schedule a consultation. We're right here in Naples and in Fort Myers, conveniently located. As always, don't settle for bad advice. Investors will settle for mediocre bad advice for years. Change is good. Talk to a firm with 30 years of experience. We want to help you get your portfolio going in the right direction, give you real advice and real management of your wealth. Don't go it alone. A second opinion is extremely valuable for you and your financial security. Rocco from Fort Myers, Florida. I tried watching and listening and reading your information each week, and I have a question for you. I'm still working and wondering what one should do with a 401k plan before recession hits. Ride it out or shift it to something safer. I'm 64 years old, but plan to work for at least another 3 to 6 years. Rocco, great question. If you are currently working and you have a 401k plan, you are limited on the kind of options, Rocco, you have in your plan. You got a couple choices. Either one, the money stays in the plan and you do the best you can with what you've got. If you retire, you can move that money into a self-directed IRA. But even though if you're not retired, some plans today allow you to do what's called an in-service transfer to an IRA, even if you're still working for them. So what I would say is check with your plan administrator, see if they allow an in-service transfer to an IRA while you're still working, still tax qualified. Then you could have professional money management by Rezny Wealth Management. Or you stay within the plan, you pick from with what you have. If a recession hits, again, what's your strategy for risk management? It's going to be very hard for most investors, unless you do a lot of research like a firm like ours on a daily basis, to know when the recession's coming or what you should be doing to hedge your portfolio. If you spend a lot of time to educate yourself, sure. Most people don't have that time, interest, or talent, and that's why they rely on a real money management firm like Rezny Wealth Management. So again, find out those few questions I presented to you about your plan. Maybe you can have it self-directed, and that way you'd have a risk management strategy in play if the next recession does in fact hit. Ralph from Cape Coral, Florida. There are a few different shows on Saturday and Sunday. I interviewed 2 different firms, and both say they are fiduciaries, but both try to sell me a security benefit annuity. How can they be fiduciaries? Ralph, that's a great question. So in general, what you will find is a lot of these firms are what's called fee-based. They might do some fee-based work, and that would qualify them to be fiduciaries some of the time, or a fireman some of the time. If they're selling you an annuity, any kind of an annuity, now I'm not talking this annuity that they're pushing, but any annuity at all, any commission product, they're working under suitability. So what they're doing is, I call it the bait and switch. What they're telling you is, yeah, we're a fiduciary, but they're not telling you when we sell you an annuity, we're not a fiduciary. They're not telling you the facts. What I will tell you is because of my TV shows and radio shows, the last 7, 8, 9 years, investors are getting educated. And what's happening is these other firms now are realizing they're being asked the tough question, are you a fiduciary? The problem is they could be a fiduciary, but you don't want a fiduciary. You want a fee-only fiduciary money manager. If the firm's not fee-only, then they're working part-time as an arsonist and part-time as a fireman. Part-time is not good enough for your retirement security or your portfolio. Go to my website, download for free Why Annuities Are Dangerous to Your Wealth and Retirement. That's a great report to read. And also download our Fiduciary versus Suitability Questionnaire. That questionnaire, if you went into one of these firms that claims to be a fiduciary, but they're trying to sell you an annuity, have them fill out that form that they're a fee-only fiduciary and have them sign off on it. Now you've got legal recourse against them. I will tell you, they won't sign that form, and they'll probably escort you out the office because they'll know the gig is up. There's a lot of these charlatans out there that are bait and switching people. Tell them they're a fiduciary, and they're not. Or get it in writing on their letterhead that they're a fee-only fiduciary money manager, and have them sign that on their letterhead. They won't do that either. Bottom line, you got yourself an annuity charlatan, not a fee-only fiduciary, and you better be careful for your money. Will from Chicago. I have both a Transamerican Jackson National Variable Annuity, and neither has kept up with the market and seem to be just as volatile. Why? Will, excellent question. Variable annuities in general, and again, the ones that you have, they have different series, and I don't know the exact expense ratio, but I'll talk in generalities. Most variable annuities that we review at my office have an annual expense ratio, depending on options, of between 3.5% and 4.5% a year. So that means if your expense ratio is 4.5% a year, Will, and the market goes up 10, you're taking 4.5% off what you just made. So of course, you're only making what? 5.5%. You still have all the volatility, but after expenses, you're keeping about half what the market made if in fact it was up 10%. That's why I hate annuities. Variable annuities or equity index annuities. These things are not good for the investor. They're only good for the salesman. The only people that sell annuities are people that work under suitability. They care about their pocketbook and less about yours. Find yourself a fee-only fiduciary money manager like Rezny Wealth Management. Go to my website, reznywealth.com, and check out more about our firm. Results, retirement security, and peace of mind. Experience the Rezny Wealth Management difference. My advice, never settle for bad advice. Get a second opinion. Call and schedule a consultation with my firm today. You do not have to settle any longer for conflicts and bad advice. It's time you looked out for your retirement security and your wealth. Don't let somebody take advantage of you. The only kind of firm ever to work with is a fee-only fiduciary money manager. I'll see you next week.